Yeah, what's up, guys? So in this video, I'm going to talk about how inducements is messing up your trade, and I'm also going to first of all explain what inducements are and why you need to pay attention to inducements before you take your trade, and how you can also handle inducements in your chart. Now, if you have been following me for some time, you know that I trade a very simple system, a simple smart money system, which normally all I look out for is a breakout structure, a change of character over here. Then I tend to look for inducements in the market. Then I wait for price to take out those inducements, tap into my zone, which actually referred to as the golden zone. The breakdown of how I got to come about that golden zone actually is available in my self-model course. So check the link below this if you want to get access to that. But apart from that, just pay attention to what I'm going to be teaching you in this video. So once price takes this out, then gives a change of character or a shift in market structure, then I can take my trade over here. So this is basically what my setup look like. This is basically what I look out for in any single pair that I want to trade. Now, this works very well on BTC, which we actually took a trade recently that we made good amounts of money actually on BTC. So you might also want to subscribe to this channel, join the WhatsApp channel in this below this video, so that you gain access to some of those signals as well. Now, what inducements actually mean in the markets is that this whole movement over here, all right, is what we refer to as inducement. Now, inducement is just a way smart money tricks traders to make the wrong decision. So in wrong decision in the sense that in this particular movement over here, all right, once we start seeing retracements, price retracing to this level, then smart money will push it a little bit. Then people will start buying. Then all of a sudden it comes back, take them out of that trade. Then they push it again. People too start buying again. Then it comes back, took them out, takes them out of that trade until most people lose their accounts over here and give up on that particular trade. Then when they are done with that manipulation, the smart money now start moving the market in the actual direction. So this whole thing that happens here is what we refer to as inducement. Now let's look at the GBUSD charts and look for an example of what we refer to as inducement. Now, can see that in this whole movement over here, we had a very clear, we have this structure over here, we had this low over here, then we'll have this little kind of change of character or breakout structure just around this area. Then we'll start seeing this movement, price comes down, then start pushing upward, and some people start buying, thinking that okay, oh, price is going upwards, then it comes down again, take them out, start buying again. So this whole thing continue happening. All right, people start buying and selling in this particular level, and price comes down right now and takes everybody out of the market. Now, two things you are expected to see in the market when something like this occur is that price either starts to continue going downward, meaning the entire trend is going to change, or it will create a kind of change of character on the smaller time frame, then it will continue going upwards. Now, this whole movement over here is what you will try as much as you can to avoid in the market. You don't want to be taking trades in this level. Even if you want to take trades in the level, you should not plan to hold that trade very long. Even if you plan to hold it very long, you must have a system that helps you mitigate your stop loss once a push upwards occurs. What I mean by that, let's say for example, if you go down to the smaller time frame in this particular area where you have inducements, you maybe if you took the trade on a 15-minute time frame, you want to go down to the 5-minute time frame, look at the structure. If it creates a breakout structure above the level where you entered your trade, you can just move your stop loss to the recent low that was created in this particular bullish scenario. Now, another way to also filter inducements in the market is by dividing that structure by two. Now, what I mean by two is that mapping out the premium and the discounts of that particular structure. Now, all these teachings are more detailed in my course. Now, as you can see over here, you will see that most of these setups are actually going to be given above the discount area. This area is called the discount and this area is the premium. So when you see setups above this area, they are most likely going to be inducement, because what they are actually doing is that they are gathering liquidity that the price will come back later to come and sweep. Liquidity in this sense is just stop loss, because each time you enter a trade over here, obviously you are going to place your stop loss around this area, right? So later price is going to come down to take out this particular level over here. So there are certain levels here that myself personally I look out for price to at least tap before giving me setup, which I refer to as the golden zone, all available in my soft model course. So in this case now, this is where I will be interested. All right, if I'm to buy GBUSD, this particular move over here is the move that is going to pique my interest. All right, after these guys have been removed over here. Now you can actually take a scalp in this particular movement, or you can take a day trade in this particular moment. But like I told you, you need a system that will help you to move your stop loss to your entry, or break even in case this turns out to be inducement. Now um another thing that you might want to take note that you can use to identify inducement is that the lows most times, the swing most times, do not create solid breakout structure. All right, they don't normally have, like, if you go to the 4 hour time frame, all right, for more accurate data, I always advise using the 4 hour time frame for your structure. Now, if you take a look at this particular level over here, all right, you will see that this movement was very strong. All right, this movement was very strong, and we had the body of this candle closing above this area. So this area was actually a valid breakout structure. Now, another way to identify inducement is that if you look at these moves over here, see that they did not actually have the body of the candle closing above the previous candle over here, which shows you that these are actually manipulation. So you want to wait for price to come down, take out this in this stop losses over here, then before you can look for a setup around this area. So these inducements are actually one of the reasons why some people, when they take trades in the market, they take the first one, it takes them out, second one, it takes them out, third one, it takes them out, then they be like, the market is or my village people is against me. No, you just understand how inducement work in the market. We can see it in every single structure in the market. Like if you take a look at this particular structure over here, you will see that if you still measure the 50% all the way up to this level, which is the structure, you will see what actually happened here. That initially markets came, created a normal breakout structure, then came, pushed up, then came down, keep pushing up, then came, finally cleared everybody here and started going up to create another structure again. So you need to look out for inducements when you are taking your trade. So how to avoid them is to try as much as you can to take your trades, all right, or look for your setup inside the discount zone. So if price briefly taps into the discount and push up to give you a setup over here, I will consider that an inducement. Now, another reason why taking trades inside the discount zone is very important is that it gives you better risk to reward trade. Now, what I mean by that is, let's say for example, you are inside this inducement, you take a trade over here. Obviously, you might get your setup around this area. Then normally, if you are going to be holding this trade, let's say for like more than a day, it is always advisable that your stop loss be below the structure. All right. Now imagine you targeting just this level. You will see that you're going to be doing 1:1, which is not actually a very nice risk to reward. But if you are able to get your setup, let's say inside this area over here, all right, then your stop loss, you move it just around this area, you can see that you are getting 1:2. So this gives you a better risk to reward. So you need to pay attention to how inducements affects your trading when you are trading. The normal advice I give to people is that don't just trade randomly, trade with structure, understand market structure, understand price action. And these are some of the things that I teach in my soft model course. The link below this video. So guys, if you love this video, if you learned something, make sure you subscribe. Take care and do have a lovely trading week ahead. Bye.